It's the largest tech IPO we've seen in the US in several years.
3 IPO opportunities so they can get bailed out to the tune of $2 billion so they could pay their damn bills because they went so deep in debt.
The debt levels are high, the burn is high, the growth is absolutely incredible.
Clients come into us and they are saying, CoreWeave, we recognize you're the best at delivering this infrastructure in the space. We need more.
That the amount of capital that you can raise in the big core AI firms appears to be unstoppable.
So CoreWeave just IPO'd, and the market's reaction might be the biggest signal yet about where the AI boom is really headed. Priced at $40 a share, CoreWeave raised $1.5 billion, way below the $2.7 billion target. But despite a shaky start, short interest spiked, fueling a squeeze, and now investors are split. Is this a reset for the AI trade, or just a prelude to something bigger? Even co-founder Brannon McBee isn't backing down. With the stage set, let's quickly rewind. What is CoreWeave? Why does it matter? And what does this tell us about the future of AI hype cycle and its infrastructure? This wasn't just about one company's stock performance. It was a signal flare for the entire AI investing landscape. CoreWeave's story is full of contradictions. Explosive growth, staggering losses, massive potential, and enormous risk. And right at the heart of it is a company that isn't building AI models. It's building the very infrastructure that powers them. CoreWeave began in 2017 as an Ethereum mining operation, taking advantage of GPU-heavy workloads to generate cryptocurrency. However, as Ethereum shifted away from proof of work and mining became less profitable, CoreWeave pivoted. The founders saw a bigger, more enduring opportunity: the GPU compute market for AI and HPC, high-performance computing. So they transitioned from simply using GPUs for crypto to renting GPU infrastructure to AI developers, researchers, and enterprises. This pivot positioned CoreWeave at the intersection of two massive trends: the rise of generative AI, requiring massive compute to train models like GPT-4, DALL-E, etc., and the shortage of GPU availability, especially Nvidia's high-end models, H100s, A100s. While cloud giants like AWS and Azure offer general-purpose infrastructure, CoreWeave optimized for AI-specific workloads. Their infrastructure became especially attractive to those needing real-time inference and large-scale training capabilities. Their data centers are built from the ground up for AI, low latency, high throughput, lightning-fast processing. This isn't general-purpose cloud, it's purpose-built and battle-tested. And here's where it gets interesting. CoreWeave's secret weapon is a tight relationship with Nvidia. This relationship became its strategic edge. They were able to secure early access to GPUs during a global shortage, thanks to partnerships and capital injections. Nvidia themselves became a customer and investor, validating CoreWeave's positioning as a key enabler in the AI supply chain. So, is the AI trade dying out, or are we finally entering the phase where it gets real? For months, investors have been whispering the same question: is the AI trade already played out? Can giants like Nvidia keep delivering jaw-dropping returns? Or are we about to find out that the ground beneath us is more fragile than we thought? CoreWeave's IPO dropped right in the middle of those fears, and its rocky performance only added fuel to the fire. The company aimed to raise $2.7 billion. Instead, it landed at $1.5 billion, pricing shares at $40, well below what insiders had hoped for. When trading began, the stock bounced unpredictably, leaving investors torn between excitement and anxiety. The media pounced. Bloomberg called the debut a harsh dose of reality, exposing the hidden costs and complexity of AI infrastructure. The New York Times described it as a gut-check moment for investors drunk on AI optimism, seeking alpha raised red flags around CoreWeave's heavy losses and its overdependence on Microsoft and Nvidia. But while others saw trouble, some saw clarity. Maybe this wasn't the end of the AI trade. Maybe it was the beginning of a smarter one. Let's break this down. CoreWeave isn't your typical AI company. It's not building a chatbot or an app or chasing virality. CoreWeave is building the muscle of the AI world. The hardware, the compute, the infrastructure. Clients include Microsoft and Nvidia. Need we say more? CoreWeave isn't flashy, it's foundational. On the surface, the growth looks unbelievable. $16 million in revenue in 2022, $1.9 billion in 2024. Yes, billion with a B. That's more than 100x growth in 2 years, which is unheard of, especially in cloud infrastructure. But it came at a cost. CoreWeave lost $863 million last year, and it holds over $8 billion in debt. What's even more alarming is that 77% of its revenue is tied to just Microsoft and Nvidia. So we're looking at a company with breathtaking momentum, but also deeply exposed to risk. If either client pulls back, CoreWeave doesn't just take a hit, it takes a fall. It's a high-wire act without a safety net. And that's exactly what's making investors jittery, but also intrigued, because if CoreWeave pulls this off, it's not just another growth story, it becomes the backbone of the AI economy. Here's the thing few are talking about. We've spent the last few years obsessed with the faces of AI, apps, assistants, interfaces, but those tools are nothing without compute. Real, raw, specialized compute. Every AI model, whether it's generating text, driving a car, or diagnosing disease, needs massive processing power. Traditional cloud can't always cut it. That's where companies like CoreWeave come in. Along with peers like Lambda and Voltage Park, they're not just offering servers, they're building an entirely new layer of the internet, one designed specifically for AI. If Nvidia is the arms dealer of this revolution, CoreWeave is the battlefield logistics. And if AI is the new electricity, CoreWeave is building the grid. Let's put the rumors to rest. No, the AI trade isn't over. What we're seeing is not a collapse, it's a correction. The hype phase is winding down. Now, we're entering the build phase. Speculative plays are getting filtered out. Foundational companies, the ones making AI work, are stepping into focus. CoreWeave isn't perfect, but it's doing something very few companies are even trying to do. Yes, it's burning cash. Yes, it's deep in debt, but it's solving the problem that every other AI company depends on: access to compute at scale. That's not a gamble. That's leverage. And in a maturing AI economy, leverage matters more than hype. CoreWeave's IPO didn't send the market into a frenzy, but it did something more important. It sparked a real conversation about what matters in AI, what's sustainable, and where does the value truly lie. It's not in the flashiest demo, it's in the plumbing, the pipes, the infrastructure. CoreWeave might not be a household name, but companies like it will shape the next decade of AI. The AI trade isn't fading, it's evolving, and the next great opportunity might not be the model you see, but the machine that makes it run. Thanks for watching. If you gained any value from this video and think other people could benefit from this information as well, please give us a like. It helps the channel enormously. And also, if you learned something from this video, check out the next video on screen to learn even more. With that all said and done, enjoy the rest of your day and take care.